What is the biggest problem for active investors or traders of the stock market? Well, it's trying to keep your money invested. And in doing so, trying to find stocks that potentially have an uptrend or about to start an uptrend. And then to manage those stocks when they're open trades, if they go down, to cut out at a small loss, or if they continue to go up, to let the profits run. Now, getting your money in the market is one of the biggest problems as well, where it's pointless allocating some money to the market and then not getting your money in the market because you don't know how to find opportunities, or there are too many opportunities, or there's so much noise going on in the world, and all the negative stuff and the positive stuff and the stuff you hear down at the pub or at the sports field or wherever it may be. How do we solve this challenge? Well, I'm going to use an example. And the example I've got here is Axon Enterprise. I don't know what it does. I don't need to know what it does for the way that I invest. All I need to do is look at the price action. Sure, I'm a technical analyst, but technical analysis can be very subjective as well. Just look at that chart in front of you. It's got lots of ups and downs. It's a bar chart. Sure, you could go to candles. You could go to all different ways of doing pattern analysis. You can go to Renkos and Ichimokos and all sorts of things. You can do typical trend analysis. Now, this chart, the last bar on the right-hand side over here, is the 18th of October, 2022. This is a trade, an historical trade that was done in a public portfolio that I manage. And it's public because I have been showing our customers since January 2016, the live trades that we do, the real money trades that we do. And we are often faced with a blank chart like this. And there it is, 18th October. Now, would you get into this trade? And what evidence would you use to get in? Besides all the noise going on around the market, you might go and look for newsletter reports or announcements or whatever, and also take into consideration what is happening in the market. The market's in a downtrend, which it certainly was in October 2022. Things are not looking flash hot to take a position in this trade. And if you've got a trained eye, technical analysis, you'd realize that it's made a lower high than the previous high some month before that, and it had made a lower low just prior to this as well, depending on what you determine as a low trough, but certainly not looking good. Now, you could also fill your chart with technical analysis, and you could use support and resistance zones and trend lines and all sorts of things, and look at where the previous high was. You can put a bit of Fibonacci on, but there's a lot of noise and it's highly subjective. Now, I'm going to show you what we did with this trade. Now, the way that I actively invest, and I use a medium-term system where average hold periods are some 3 to 4 months, is I take all subjectivity out of the equation. And I am a mechanical active investor. So I use a rules-based, non-discretionary system. And I've been doing that for decades, in fact, since 1998. And what that does is it basically means that we don't use any technical analysis. We don't listen to anything that the market's saying. We don't even give regard for what the direction that the market's going in for this particular system. Other shorter term systems we do, but this medium to longer term system, we don't do that. And effectively what we use is an algorithm which we have researched. That algorithm gives us entry and exit signals and is programmed into the software, obviously. And that allows me to manage 3 public portfolios, as well as my other portfolios that aren't public. And it takes me, literally for all my portfolios and money in the market, less than an hour a week. But in any single portfolio, it doesn't take me any more than 15 minutes a week, because all of the research and all of the subjectivity, if you like, and all the discretion went into the research before I started trading the market. That research presented me with an edge through going through the research. Sure, I did the research and used all sorts of tools, and I put thousands of hours into doing this. And now I have a process that while I'm executing it, I don't have to worry about anything. I don't have to do any analysis. I don't have to do any reading. I just follow the system, because all of the subjectivity and discretion is built into the system. When this entry signal occurred, which you can see on the right-hand side, there's an entry signal over there. I took this trade. I got in the next day, the day after the entry signal. So the entry signal was on the 18th of October. We entered on the day after, because you only get the date at the end of the day. And the trade then starts. Now, we have no idea what's going to happen going forward. All we are doing is following the probabilities of the system. Where do those come from? They come from all the research of the decades of historical data we looked at. and we let those probabilities play out. Now, I'll show you the probabilities that we were aware of before I actually entered the trade. At the time of doing this trade, the probabilities were that we had a 54.17% chance of winning. And if we did, our average win, the win that we could have compared to the loss we could have, because we could also have a 45%, 46% chance of losing, our win would be 4.25 times bigger than a loss that we might have as a result of this trade. Now, we have no idea where this trade's going to go. In fact, at the time, the odds were it was going to go down, given what was happening in the market, and there hadn't been a breakout yet above a recent peak. Those were the probabilities based on the 48 prior mechanical trades that had been done in research. And a whole bunch of these trades occurred after the research had been done and had been added to the research data set. Those are the probabilities we were aware of at the time. So how does this trade play out? The signal happened on the 18th of October, entered the 19th of October, and we would have worked out the position size, the methodology would have worked out the position size in a portfolio, and we did this trade. And what transpired with the trade is it started going up from the get-go. Now, results were about to be, third quarter results were going to be announced in early November sometime. We didn't let that come into the reckoning because that is noise. And the trade started going up immediately. Results were announced and the trade jumped quite significantly around about, I think it was the 8th of November. The results were announced. Now, we didn't know that was going to happen, as I said before. And the trade played out, went up. The profits were obviously taken in the short term. Our long-term, our indicator, our unique mechanism that we use did not give an exit signal. You can see that this trailing stop continued to hold its ground while the price came down. The line got very close. Now, we only exit when end-of-day data transgresses the trailing stop line. You can see that happened on that bar over there, but no exit signal. Price continued to rise. Trailing stop trailed higher. This is a volatility trading stop. It's one that I've personally spent many hundreds of hours looking at and programming and researching myself, as well as part of my team as well. We re-research these indicators as 2, 3, 4 years of data added to the data set. We go and re-research and fine-tuning tweaks to the actual algorithm. Now, another big bar over there, intraday dropped below the trading stop, did not close below the trading stop. So we continue to hold this. Now, this is all mechanical. Sure, there would have been some news that occurred on that day that caused that to happen. If you were overcome by that news, overcome by henny penny, the sky's going to fall on my head, I need to get out of this now, then you would have sold and left a whole lot of money on the table. Because you see, that's what really people fear. The first at the start of the trade, they fear being wrong and fear losing. And then as the trade matures, they fear leaving money on the table. So they stay with it and sometimes stay far too long when there's a retracement. And of course, people also fear missing out as well, missing out on opportunities and profits. So these fears are playing off in our head all the time. And we need to overcome these. And if we don't overcome them, then the market's just going to pull us from pillar to post. And we're going to make lots of little mistakes and a few big mistakes. And those all add up to get an equity curve in our portfolio that just goes south rather than north. And if it does go north, it doesn't go north by enough to actually get the outperformance you would get from putting your money somewhere else with some other third party or something. This is what mechanical trading, mechanical active investing is all about. The trailing stop price then rose again, another big rise up. And so it continued up. Trailing stop trailed it higher, meaning that all the time, all of this profit now is locked in. Sure, we could have a big fall at the end, a really big bar like we had over here, and close down below. That does happen. And then we would have to exit the following day and give back a bunch of profit. But them's the breaks with the market. And so the trade continued and another new high was made. A retracement occurred right at the end of the trade here, and we got an exit signal. And that exit signal, we exited. So the exit signal occurred on the 28th of April, 2023, to get out on the following trading day, which means we would have got out at the close on an up day. We exit, we trade market on close with the system. So that registered a 73.5% profit trade net of costs and added $6,400 to the portfolio. So that's an example I wanted to take you through. Overcome emotion, overcome discretion, be totally objective, remove all the subjectivity. That's what mechanical trading is all about. And that's what we've been doing with our clients since 1998 and I've been a mechanical investor since I started researching the stock market in detail in 1990. So I hope that helps. And nothing here should be taken as direct investment advice or specific or personal investment advice. And of course, past performance is not a reliable indicator of future performance. As always, I wish you consistent and objective investing.